when you are running a business, whether a man, woman, or a partnership, it is paramount important that you ensure business does not run out of the money before it is able to deliver its product or services to their final consumer. So, and it is also vital to ensure that it does not run out of any money before it was time to sell its product or services. So, finance are the main lifeline of business. And in the absence of money, business cannot sustain. So the sources of a continuous flow of money needs to be established for a business survivor. So the needs for adequate finance for any business to start. It needs some working tools like equipment, buildings, machineries. And if, take for example, a fish seller want to engage in business, this type of business, the seller will definitely need one table, knife, cold room, and weighing scale, which of course has to work in line with his own objectives. So all these items I mentioned above, they are referred to as capital, because without money, the table, the knife, the cold room, the weighing scale will not be available. So, and if that should be the case, a decision has to be taken whether to buy that items or to lease them. And if they are bought, they are referred to as capital for the business. And the money needed for a day-to-day running of that business is also called capital. But in that case, that is working capital, because money that has to be used to buy the fish, either Aries or any other types of fish, to the cold room, are regarded as working capital. Either to lease or to buy, this is determined by the cost of capital, because both the real capital and the working capital has to be combined together. And if it is cheaper to lease than to buy, then it will be advisable to lease rather than to buy. So the cost of stock of fish, that is the amount of fish which she needs to keep, should be calculated along the way. So with the running cost of the business, the day or the weeks before our customers could come to buy or pay. So now, sources of finance. People seem to look out for banks as the only source of finance. Bank is not the only sources of finance. So any businessman or woman throughout the financial windows market, there are financial opportunities other than commercial banks. So there are a lot of other places where one can source for money so as to kick off a business. Like when we talk of the building societies, we talk of the merchant bank, we talk of the mortgage finance, then cooperative societies among the rest. Now, even the borrowing from the relatives is also part of it. Businessmen are always afraid of patronize some of these ventures capitalists, because they were not all known to them, and they often request for high percentage of interest on the loan, or they have shares of companies, and it is more business-like to take such risk by of business never be implemented of this. So it is not always possible to get something from nothing. So when you use the finance house, the people will need to maximize their own profit from receiving your the bank employs you, deal with many, you may be addressed in customer-friendly title, like managers, the business managers, and the marketing manager. They are something in which is what business is all about. Now, securing of a loan. Loan, what is loan? They are the amount of finances which a business man or woman obtain from somebody who is not a co-owner of that business, but to be paid back on a specified period of time, say a month, 6 months, a year, or more. So a lender of fund do always require some securities, which is otherwise called a collateral sometimes, so as just to safeguard their funds that was given to the person or that is going to be given to the businessman. So this collateral security could be in form of certificate of occupancy, or this certificate of house or land, or certificate of company, that is incorporations. Then share certificate of a reputable company. What does that mean? If somebody purchased share in a particular company that has its names and has the financial standard, so it's equivalent to the collateral security as well. Even personal asset like car, building, so they also serve as collateral security. Now, letter of set off, meaning that you have a savings account, let's say 3 million naira, and you need 5 million naira. So the 3 million naira will be used as a collateral to be given 5 million naira. So therefore, you will be allowed to take a loan of 5 million naira, but you will not withdraw from the 3 million naira until 5 million naira is fully paid. So that means that is another way of sourcing for finance. Now, as I said earlier, we have loan from friends, relations. This is type of loan. Of course, it is very cheap or cheaper in nature. It does not require collateral security. And at times, it doesn't have even the interest rate. But they are difficult to come by, simply because it's a mutual understanding between the friend or relative to assist one another with finances, so as to run their business with a stipulated time of paying back. So at times, this loan, that is the loan from friends or relations, they are never being paid back by the friend. So the risk of bad debt here might be very high, and sometimes it could result to court case. Why? Why can it result to court case? That is when a friend or a younger one borrowed money from the senior one and could not return the money back as at when promised. So the senior one or the junior one that has given out the money can now go to the extent of lodging the this understanding. Interest payment might be deferred or waived depending on the closeness. Now, loan from commercial bank. When we are talking of the loan from the commercial bank, I think I've explained that one little, but let me comprehensively explain that, of course. So the law in the law in the loan from the commercial banks is different from that of the friends or relatives, because the loan here are quite different from the loan from the friend, and the interest is always charged. We always charge, and it is higher. So the loanee needs to provide that the person collecting the loan is the loanee. it has to what? The person has to provide the collateral as security for the amount to loan and are for specific period. So the bank loans are safe and secure for both the loanee and loaner. That is, if it is the commercial bank's loan, simply because of the collateral security, both the loanee, that is the person that is receiving the loan, and the person that is giving out the loan, that is the bank, they will be in a secure position. But in this case of commercial bank, the interest are paid as at when due, while the principal sum are also deducted along the side with the interest. Now, the contribution by the owners of the business. When we are talking of this one, of course, it is very simple and is the most common aspect of the capital that always available for the business, because they are more or less equitable than loan. So the business owner contributes their quota in form of either money or other form of asset to start the business. So the amount to be contributed cannot be repaid by anybody except in an event of liquidations of the business. So under this type of loan or this type of method of gathering money, nobody will be charged interest, but rather the profit and the losses of the business are shared among the owners. Okay, take for example now, if Mr. A and Mr. B join the business together, maybe I've contributed like or I was able to save 200,000 naira for the past 3 or 4 years, and likewise Mr. B was also contribute or save up to that amount, and we now contribute 200 from A, 200 from B, making 400,000 naira. Are you getting it? So at the end of the day, if we have entered into a business without 400,000 naira, and at the end of the day, Mr. A wants to pull out of the business, we have started the business and the profit as well has been sharing. Even if it is loss, we have been sharing the loss. So the issue here is this: if the business is liabilities company. Now, sharing another one is sharing the cost of a business. In sharing the cost of a business, first of all, we have to identify the type of business. Is it one-man business? Is it partnership? Or rather, is it a public liabilities company? So it is at this point that one needs to know how the cost of the business could be shared. And you should be aware also that in a one-man business, the cost of business cannot be shared with anybody, except you have to look for a loan or raise the fund yourself or through other means. Why in other types of business like partnership and the public limited liabilities company, so you could approach your shareholders so as to raise the fund for their expansions, and you ask them to finance a new project. So since the shareholders are interested in the increase of their shared dividends, so they usually require that their company is worth a lot more as a result of completing a new project. So in the case of public liabilities company, fresh shares could be sold to the public through the issuing of an initial public offer, IPO, where the people could subscribe to the offer, and through its fund, they are being raised to expand the company. Now, let me give you a scenario here. It's just like a company that is into a business, probably with the total amount of 5 million naira. They now discovered that with this 5 million naira, they could not satisfy their potential buyers or customers outside there. So they will now struggle to make sure that the company is being listed. And if the company is being listed in the stock exchange commission rather, so that means the certificate will be issued to them so as to give them the opportunity to sell shares, to advertise for their shares. And the moment they are able to advertise their shares based on the goodwill and the reputable name they have made so far, so majority of the and you now discover that you want to buy the shares. Are you getting it? So at the end of the day, series of the people that are interested will come to the company and buy their shares. As a result of buying shares, like 5 units, maybe 440 naira 50 kobo per unit, and somebody want to buy thousands, 100, so they will just multiply it. So by the time they are being paid that money for the shares, their level of capital will also increase. So that will now add more to their 5 million naira that is in the operations. I think you all get it. So sharing of the profit. The profit of the business are shared based on the amount of capital contributed. 200, as I said earlier. So the 400,000 naira that has been invested into the business, if the business brings like 50,000 naira, like okay, making 450,000 naira all along, so they would now share it. You should also know that the managers or the executive or the chief executive of the company do not share in the profit of the company, but they only receive their own wages or salary for managing the business. If the investment is one-man business, then the profit can be shared. I think you get it. Now, sharing of loss. What is applicable to the sharing of the profit is also applicable to the sharing of the loss. In the case of losses, the shareholders take their part of the loss according to the ratio of their contributions to the business. So, like if Mr. A has contributed 200,000 naira and Mr. B contributed 150,000 naira, so our profit was shared based on their own contribution. So the losses will also be shared. So now, event when the business fall off, they are only liable to the tune or amount they contributed in starting the business. The liability of this business has nothing to do with their persons or their personal properties. It is only in the case of one-man business that the owner has to be liable to the extent of his personal belongings. I think that is clear. So the way the profits will be shared, so the losses will also be shared. So that is that on the chapter 1, the basic concept of the business finance and the principle of the business finance. Now, introduction to the finance. Now, what is finance? Finance could be defined or has been defined by different authors. We have different schools that have defined the finance. But basically, finance could be seen as a science of money. And it is studying the principles and the method of obtaining the control of money from those who have saved it and administering it by those whose controls it passes, that is the managers. Of course, according to the Kuchao, he defined the finance as the administrative era that is set of administrative functions in organizations that relates with the arrangement of the cash and credit, so that the organization may have the means of carrying on its objective as satisfactorily as expected. And another person, Upton, business finance, that which includes business activities that are concerned with the acquisition of and conservation of the capital funds in meeting the financial needs and overall objective of the enterprise. When you look at the way Wellers also define the finances, he said financial resources derive other resources in its train. For without the finance, other resources cannot be achieved. So finance is therefore the basic resources that can be used for the creations of and maintenance of other resources. Okay, let me explain better in this regard. If you are talking of the resources in every organization, we have three resources: material resources, financial resources, and human resources. Of course, to this your level, we call it 3M. That is money, men, and materials. Materials, men, and money. To this your own level. It is only at the professional level we call it financial resources, material resources, and financial resources. So that is it. Without money, the materials resources will not be available. Without money, human resources will not be available. Now, what are the functions of finance in the business? Financial management is the managerial capability that are very concerned with the planning and the control of the firm's financial resources. So there are two kinds of finance functions. We have the managerial functions or incidental functions, and we have this a kind of planning, controlling, and executions ability. So the three important managerial finances functions are investment decision, that is the asset mix; financing decision, that is the capital mix; and dividend decision, that is profitability allocations decision. So now let me explain here. When we are talking of the investment decision, these managerial functions of finances will let us understand that, okay, these are the volume of the materials, assets that are needed to be made available in order to run the business. So if the financial capabilities of the businessmen will be able to take care of that, then they will go ahead with that type of business. Now, financing decision, that is capital. So if the materials if the money will not be available, or the money that are available will not be enough to acquire that asset, that is financial decision or financing decision, then the owner of the business may now pull out that, well, I don't have money that can be enough to start this type of business. Then dividend decision. Another one is it's also functions of the to now determine if I should invest 5 million naira, this 5 million naira into this type of business, will it bring profit for me? Okay, if it is going to bring profit for me, like the last lecture we had, I think I told you there are some factors or tools that can be used in determining feasibility and profitabilities of the business. So this is the area, the dividend decisions is the area whereby the tools has to be used in order to determine if that business will be enough or will be able to pay itself back as planned. Are we getting it? Now, incidental or routine finance for effective finance function, the routine function must be performed. They are: one, supervision of the cash receipt, payment and safeguarding of the cash balance, security and insurance policies, and other valuable papers, taking care of the mechanical details of the new outside financing. What are we talking about here? You know, even if you have the money, if the money will be enough to, and you have used all the tools to determine the profitability looking for job. They will be telling you they can work without any or supervision. It's a lie. They are just trying to cajole you so as to just employ them first. That is when every one of them will be needed to supervise. Are we getting it? So the supervision of the cash receipt must be put in place. Then we need also to safeguard the cash balance. What does that mean? Keeping of the records. The debit side of the account, the credit side of the account has to be identified and noted, so that at the end of the day, the variance, the difference between the debit balance and the credit balance will be what? Will serve as an indicator to the profit or to the loss. I think I'm communicating. So that is, and then why the routine managerial finance functions are also carried out by the people of the lower levels. I think I've said it, because they need to be
Mr.
supervised.
Adesina, time up. Time up.
All right. Okay. So thank you very much for your time. The last assignment given to you has not been submitted. It was just 4 of you that submitted. So against next class, try to submit and read your materials as expected. I wish you best of luck in your exam. So thank you very much.